How's it going, everyone? Welcome back to another episode. So in this video, we're going to be talking about what an IPO is. We're going to just scratch the surface with the meaning of what an IPO is, and we're also going to take a look at a range of existing companies that have IPO'd either this year or a few years ago. So the first thing I want to do is just point you towards a video as to what an IPO is. I'm going to add the link to the description, but on my side I'm just going to provide a brief summary. So an IPO stands for an initial public offering, and in effect an IPO allows a company to raise money, and in exchange shares will be issued for an investor, and so an investor becomes a part owner in the company. There's a lot of regulation surrounding an IPO. I won't be going into any of that. So one thing to be aware of is that there's generally an investment phase that takes place before a company has been registered for IPO status. It's known as a private offering. And as an example, if we go to Crowdcube, this is a way to allow standard investors such as myself and potentially you to invest in privately funded companies. Now, this isn't a recommendation, given that it can be very hard to pick the correct types of companies. There is a statistic that around 95% of listed companies do end up failing, at least for startup companies. So it can be very difficult to make a return. But this is one way of entering publicly funded companies. And so for investors that have privately funded, when it comes to an IPO, there is a significant opportunity to make a lot of money. So once an IPO, once it's registered and listed on the stock exchange, there will be a lot of investors that would want to exit. It's called an exit strategy. And so what it means is that investors that have risked a lot at the early phase now want to regain some of the capital that they initially put forward and to effectively make a profit. On top of that, there's generally a lot of buzz around. There'll be a lot of news articles that will raise the demand for a given stock during launch. There is a trend that takes place, and the trend, well, it's effectively no trend. The stock is very volatile in the early phase. So on my screen, I have Snap. Now, for those of you that remember back in 2017, we can see the first time that Snap IPO'd. It had a very volatile period. So about 6 months later, the price peaked. We have another sort of peak back in early 2018. And since then, the stock has really struggled to come to a solid level. Now, there's been talks that the $10 mark is a sensible price point. Even after 2 years, there's still no clarification on where the stock is going to settle and whether there are good growth opportunities in the future. So that's all I really want to focus on for Snapchat. We have a 2-year window period. So for Snapchat, we have this 2-window period, and in hindsight, we can see that it wasn't a great opportunity to buy at some of these peaks shown in the early days. Good buying opportunities if bought around late 2018. But let's look at some recent IPOs. So the first one being Pinterest. So I'm just going to, as always, modify the graph. Instead of having the 1-day view, let's put it as 1 week. So Pinterest IPO'd earlier this year, back in April. So each of these candlesticks are a week's worth of information. So the first 2 weeks, there was strong growth, even into the 3rd week. But then we can see how it kind of fluctuated and started to become negative, hence the red candlestick. There really hasn't been a great buying opportunity in the last sort of 6 months. And based on the performance from the last week, we're at very similar levels to when the stock initially opened. And this is a trend that does happen quite often. So we'll zoom in a little bit more onto the 1 year graph. That's probably a lot better to see. So yeah, April 2019, we can see we're at very similar levels. We've got initial where there was a lot of high demand, a lot of people buying the underlying share, and then this drop off, another attempt as well, and then the drop off. So that's enough for Pinterest. Let's have a look at Slack. And the graph here is pretty much negative the whole way through. So they IPO'd back in June of this year. I am going to, again, just candlestick. The trend here is just downwards, and it makes no sense to even buy a stock like this when it's just heading downwards. So there were talks around, I believe, sort of $23 that would be a sensible price to buy in. We can see it's hit lows to as low as the $21 mark. There's no clear insight as to how low the stock can drop, and so I would just stay clear of Slack completely. Okay, Lyft, another interesting stock. It initially IPO'd back in April of this year, so there's a little bit more information that we can view. So the early phase, if I just add some lines onto this graph. So here is sort of the peak level. This is the highest price it's ever been. So I've added trend lines for the first 3 months, and we can see that there was an upward trend initially, but the upward trend, you can see the gradient of the line. It's at least on the top one, and that's more important. It's still bordering the level of being flat, and so the gradient, the trend line, is sort of coming to this end, and we can see, we just add a few more just to make this super obvious. On the latter part and onto recent times, we can see how we're just completely negative. It's just plummeted, and you can zoom in and think, oh, there's been sort of an upside tick, but it's, for argument's sake, it's all negative. And so again, would I personally buy into Lyft? Not by how the initial performance is. A lot of these stocks that we're looking into, the next one, Uber, the first 6 months, the first year, they're generally negative. That is the sort of common consensus that we're reaching to. But I do want to focus on Uber and subsequently PagerDuty. So again, we've had this, we can just visualize the lines now. It's almost flat. The price point really wasn't moving initially. A slight uptrend, but it's so marginal. And then we just have this drop down from July, and we're still in that sort of negative phase. Again, we've had some price increases, but we have resistance levels since so the $34.88 mark. It's not even going to reach that. We can see it's most likely dropping back down again, and it's just following, like, add the lines in. So the latter part of the year, we just have this kind of negative downtrend, so more like that. And we really need to see a breakout. And even then, for the case of Uber, if we look into the company, $44 mark, it's a very high price. So, you know, what I would say for any of the above stocks, we've seen that the price has generally dropped within the first 6 months, and you know, within the first 3 months, stay away from any of these stocks. Now, in saying that, there's going to be other examples potentially of other IPOs that have actually done well, and maybe there's an argument to be said to buy into the stock early, but you really have to understand the company basic to not waste your money. And so for the final sort of negative trend IPO is PagerDuty, another tech stock. They've all been tech stocks, and this one is just simply put all the way negative. So started at the $42 mark, and if we look now, 26. I mean, it's slightly under half the amount initially. So should you have invested, let's just say, £1,000 equivalent converted into dollars, you'd now be at sort of 500, slightly higher, £550, and for argument's sake, you would have lost half of your initial investment. You know, we can analyze that for a range of IPOs. So there's a lot of novice investors that will jump to a lot of these tech companies because they use these technologies quite often and they want to be a part of the underlying stock. But it's very important to remember that the stock itself doesn't really care if you are an investor. The stock of Snapchat doesn't care that you hold any of the stock. The issue arises when an individual feels like they are a part of a company and so they buy into the stock really early, which is a really bad idea in investment because one, you can be passionate about a given company, but there's always a good price entry to buy the stock out. And so I've shown a lot of the negative ones. My personal advice that I give to myself these days is to stay away from any IPOs. That's not what I did initially. I still hold shares in Snapchat. I bought at sort of the early days when it opened. So you live and learn, but I wanted to share that advice. So in saying that, I do want to have a little look at Zoom as a company. So let's just add that to the recent IPO list. Let's go back, and so we have Zoom here. So looking at this stock, let's just add to the candlestick. Now, in the early days when the stock IPO'd, it was around $57 was when the stock, the stock initially opened around the 63, but there was buying opportunities all the way down to $57. Now, in the first 3 months, the stock did actually really well, and there was quite a high gradient with the growth. But since then, it has dropped down, and what are we at the moment? You can see the blue line here, $67. And for sure, there's opportunities if you want to have a stock for a few months and then sell off. There are opportunities to sell. So, the $105 mark, there was a lot of money that individuals could have made, almost double if they brought. But my investment strategy is no longer to buy and sell stocks very quickly. I much prefer to hold the stock for long term, given that it's a lot easier, that there's a lot less risk holding stocks long term in comparison to trying to time the market. And by timing, I mean, let's just say we go back to the 21st of May. We have no idea how the market is going to perform the following day. And so you have to make a decision. And so the best approach, should you want to time the market, is when you buy the stock, you need to have an exit strategy. And so you want to set your stop losses at a price that you feel as though the stock will reach, and then have your orders sold automatically. Now, the mistake people make is they look at how the stock has been performing a few weeks back, what they predict the stock will be in the future, and then they spontaneously decide if they're going to sell the stock. Now, if the stock is going to drop down, as it did in June, then maybe you think, oh, okay, it's dropping, but I'll hold on to the stock. It may recover. And if you had done that, it depended on the price that you wanted to sell at. Let's just say we wanted to sell at $106. The price has never reached that ever since. And so you still hold the stock at the price you brought it at. So the game, at least on my end, hold long term, and there's just a lot less mental overhead to think about. And so the advice I give myself, you don't have to follow this. This is entertainment purposes anyway, is to stay away from recently added IPOs. I'm not saying to not look at them in the future, whether it's 3 months, 6 months, 2 years, you're free to buy in the future. But at the early stages, there's just so much demand. There's individuals that are privately invested that want to make a profit. And so the initial offering, whatever that price is, within the first 3 months, generally quite a good time for them to sell, given that they get the stocks at sort of pennies or cents, very sort of low numbers, high volumes. Cool, so hopefully you enjoyed that video. It's been very focused towards technology stocks. Technology IPOs are very volatile initially, and In the comments, if anyone has sort of a different idea on their opinion, I'm very interested in hearing it. And if there's any examples of recent IPOs, doesn't have to be in the technology sector, and whether they've actually been performing well, and that'll be great to hear. So thanks for watching. I'll catch you in the next one.